I just wanted to ask, when is the alternative date for the exam?
The final exam, 16th.
16th? And the like the normal date? 18th. So it's either 16th or 18th.
Max Flower, it's an honor to be here. Thank you very much.
One more.
Okay. Sit any way you want.
Hi, nice to meet you.
Partnership report for the two senior guys, along with their needs.
I buy all my Chinese food at that cart now. Okay, folks. So do you realize we're in the 17th session of a 26 session class? You know what this means, right? Things are going to get really, really, really hairy really fast because in 2 weeks we have, of course, Thanksgiving. I sent you the mystery project. I know it feels like I'm piling on, and I'm probably piling on. But the reason everything comes faster is we have only about 9 sessions left, about 5 weeks of class left. So if you did the DCF and you got feedback, that's great because a big chunk of the project is now behind you. In fact, most of the project. But if you didn't do it, if you didn't get my feedback, I'll still be glad to give you my feedback. So if you never sent your spreadsheet, the window's still open, send it and I'll give you my feedback. Also, I did notice about 50 of the quizzes haven't been picked up yet. I'm going to leave them out till this afternoon. And I'm going to have to take them in because they'll get recycled very fast. Things will go missing. So if you haven't picked up the quiz, do pick up the quiz. It's not going to get picked up on its own. So let's pick up where we left off last session. I know you were a little bit of a daze after the quiz, but we started talking about pricing. And you can price just about any asset. There are assets you can't value. For instance, you can't value a Picasso, but you can price a Picasso. You can't value a Picasso because there are no cash flows. Try doing a discounted cash flow valuation of a Picasso. It's impossible. But how would you price a Picasso? What would you have to do? What's the essence of pricing? Finding similar assets, look at what people paid for those similar assets, and try to attach a price. So for a Picasso, what would that mean? Look to see other Picassos that have sold. And already you can see the limits here, right? That many Picassos don't sell. And then figure out they paid $7 million for that Picasso. And this is why you pay appraisers these obscene amounts of money, to put a number, right? You can't value wine, but you can price it. You can't value wine because it tastes pretty much the same, whether it's 1954, 1971, 1998, But maybe that's just my plebeian taste, but clearly there are these experts who say this is a better wine. They find all these tastes in it that you never even realized existed. This evening I'm going to Vegas, not to gamble. I've given up on that a long time ago. But to give a talk to 1,000 CPAs in a big room. This is almost my vision of hell. 1,000 accountants and me in one Vegas room. But I'm not going to do a show. I'm going to talk about things I don't understand in accounting. So it's not going to be a fun session for them. It's going to be a fun session for me, and then I'm going to leave. But the first thing I do when I check into a hotel is I open that deadly the mini fridge, and I check the prices. You know what? I'll send you this link. You will not believe it when I say it, so I'll send you the link. I remember about 20 years ago sitting at an appraisal conference next to this guy who used to price he said he was a hotel valuator, whatever that meant. And I said, what do you, I put numbers on hotels. And I said, how do you do it? He said, it's very simple. I go into the hotel and I buy a can of soda. So depending on the hotel, the can of soda might be that, if it's a Motel 6, it'll be at the end of the corridor in this, I add 6 zeros. Actually 5 zeros to whatever that Coke cost me or soda cost me. So if it costs you $1, you'll add 5 zeros. That'll become 100,000. I multiply that by the number of rooms in the hotel, and I have the price for the hotel. And I said, really? I thought he was kidding me. Then I went back and Googled it up. It actually is one of the hotel valuation techniques, is open up the fridge, take the can of soda out, add 5 zeros. I don't know how many rooms there are in the Venetian, which is where I'm going to be staying. But I'll wager when I open that fridge, it's going to be at least $5 a can. The Waldorf, I think, is $7.50 a can. Okay? And you can do the rest of the math. That's pricing. You think that's so unsophisticated. Who cares? If it works, right? So when you think about pricing, remember that it's all about finding a metric, whether it's a can of soda, whether it's earnings, or whether it's something else that you attach a number to, and you scale it up. So today, to start off today's session, let's do our usual pre-class test. Remember last session I said 85% to 90% of what passes for valuation out there is pricing? Most analysts, price companies, equity research analysis is all pricing all the time. So you ask analysts, why do you like multiples so much? One of the reasons they will give you is, in discounted cash flow valuation, you have to make all these assumptions. Right, about cash flows. Remember, when you did the DCF, how many assumptions you had to make and how uncomfortable you felt making them. I use multiples, so that's EV to EBITDA, price earnings, etc., because I don't have to make those assumptions. Is that true? Let's see which part of the statement is true. Is it true you have to make a lot of assumptions in discounted cash flow valuation? Absolutely. Is it true you don't have to make assumptions when you apply 20 times earnings or 8 times EBITDA? You don't make explicit assumptions, right? You just say 8 times EBITDA, but are you making implicit assumptions? Absolutely. And one of the things we're going to talk about today is making those implicit assumptions explicit. You say, why would I want to look under the rock? Because if you're paying 22 times earnings, you need to be at least aware of what you're assuming implicitly about growth and risk to be able to pay 22 times earnings. So part of today's class is going to be about laying the foundation for looking at what drives a multiple. We're also going to talk a lot about statistics today. So those of you who thought you were done with statistics have bad news. We're going to revisit your worst nightmares. And one of the things I'm going to show you is a histogram for each multiple. So I'm going to show you a distribution for PE ratios. And if you remember statistics, the one thing we all tend to remember about a statistic, the only thing we tend to keep in our memories is a normal distribution, right? Such a nice distribution. Everything is so symmetric and you can predict things. 2 standard deviations is 95%. So I have a very simple question. Can a PE ratio be normally distributed? PE ratios across companies. Can it be normally distributed? And if not, why not? What do you require for something to be normally distributed? What are the properties of the variable? What does it have to be? Minus infinity to plus infinity, right? What's the lowest value a PE ratio can take? 0. You can't go below 0. Have you ever seen a negative PE? You see not meaningful, not available. So the lowest value PE ratio can... So you floored the PE at 0. That's a low... What's the highest value PE ratio can take? Who knows? So basically you got a distribution that's got a tail on one side and no tail on the other. You say, who cares? I don't know about your statistics class, but I remember my statistics professor saying, if you have an asymmetric distribution, I had no idea what he was talking about. Never ever use the average. You see why that's good advice? What happens if all your outliers are big positive numbers and you have no outliers on the other side? When I take the average PE ratio for a sector, what am I going to find? That it's too high, right? Because it gets pushed out. And I remember again, this is one of the few things I remember about my statistics classes. My statistics professor said, when you have an asymmetric distribution, don't ever use the average, use the median. We're going to talk about that very simple adjustment to multiples and why we need to do it. Because when you use averages, you're going to overstate numbers. And you're going to find things cheap when they're not cheap. One final point. One of the things we're going to talk about is how, using pricing, do we decide that something is cheap. So let's lay the foundation for it. Let's assume you find a company that's trading at a PE of 12 and the sector average is 20. This is good news, right? At least you're moving in the right direction. For this stock, when you make that comparison, can you conclude based on that comparison that the stock is cheap? Looks cheap, right? But what are the questions? So think about this as a process. I'm a broker. I've called you with this stock. I've said it's cheap. It's trading at 12 times earnings. It's lower than the... What are some of the questions you're going to ask me to decide whether it's cheap? Think fundamentals and you'll have the questions to ask me. What are some of the reasons stocks trade at low PEs? There are only 3 reasons, right? One is it could be risky. The second is it could have low growth. The third is it could have high growth, but it's getting that growth in really bad ways. Like what? By investing huge amounts of money. So questions you need to ask me is how risky is it? What's the growth rate? And what's its return equity? By the time you ask those 3 questions, 95% of stocks that look cheap, you will find deserve to be cheap. One way to think about pricing is separating those 5% from the remaining 95%. So today, that's basically what we're going to talk about. So let's get started on that process by going back to the statistics of distribution. So when you look at a large amount of data, to make sense of it, you're asked to compute the average and the standard deviation, right? You're asked to put up a histogram, and as I said, the histograms are going to tell you whether the distribution is symmetric or not. You're going to look to see whether there's any bias in the sample. In other words, you start with 1,000, did you end up with just 620 and why? So to understand exactly what this is without dealing in abstractions, let me show you a histogram that I've kind of put together at the start of every year for the last 25 years. So what I do at the start of every year is I collect data on every publicly traded company. I compute the PE ratio for each company. And this is globally. And then I make a histogram. So it sounds fancy, but I'm just counting, right? How many stocks traded less than 4 times earnings, 8 times earnings, etc. So there's a histogram for US stocks January 2015 in terms of the PE ratios. I've actually reported 3 different PE ratios. Current PE, which is price today, on January 1st, 2015, divided by earnings per share in the most recent fiscal year, which for many companies would have been 2013, right? Because January 1st, 2015, the most recent fiscal year would have been a long time ago. It can be trailing PE, which will be earnings through probably the 3rd quarter of 2014, or forward PE, which would be God only knows what, 4 quarters starting in September of 2000. So it's some forward number, 3 different multiples. But none of them is normal, right? The peak is to the left, the tail is to the right. To show you the effect it's going to have on the statistics, I computed the standard statistics, the average, etc. The average PE for US stocks at the start of 2015 was 72. That's scary high, right? But before you get too excited about or not excited about that number, Take a look at what's right under it. The median PE for US stocks is 21. Half of all US stocks that have a PE ratio trade at a PE less than 21. That's a high number still, but not the 72 that you saw. The average versus the median. But here's, I think, an interesting, and part of the reason the average is so high is this is one stock with a PE ratio of 23,100. That must be one highly priced stock, right? It actually was trading at $7.50. So how is its PE ratio so high if the price was only 7.5? The earnings per share was a fraction of a cent. That's the nature of PE. But here's a number that I'd like you to explain. There were 7,887 companies in my sample. Those are the publicly traded US companies with a market price. But there were only 3,403 companies for which I had a current PE. What happened to the other 4,400 companies? They were negative earnings companies. Here's a nice trick question, because remember a year or 2 or 3 years from now, you're going to be on the other side of the interviewing table torturing MBAs who are looking for jobs. I'll give you a great question to try out. Ask them what the median PE ratio is for a US stock. What's the definition of median? Half of all companies traded below, half above, right? Among the companies that have a PE ratio, the median is 21. But if you look across all companies, you really don't have a PE ratio, right? Because more than half of all companies lose money. So with current PE, you can already see, you think, what's the big deal? I still have a big sample. But it's a biased sample. Why is it a biased sample? What are the companies you lost when you computed current PE? Probably smaller companies, higher growth companies, younger companies. These are not 4,400 companies that you took out randomly. We introduced bias into pricing without even thinking about it, based on the multiple we pay. In fact, as I go from current PE to trailing PE to forward PE, especially to forward PE, I lose another 600 companies. Why? What do I need for forward PE? I need expected earnings per share in the next year. I'm not going to be sitting down projecting earnings per share for 7,887 companies. I'm not crazy. So what do I look for? Somebody else's forecast, an analyst forecast, right? So who do I lose? Any company that is not tracked by an analyst is dropping out of my sample. And think of what kinds of companies those are. Usually very small companies with very low profiles are dropping out. Again, I've created bias. The next time you see somebody pricing a stock, they've used a multiple and they've used comparables, they've already introduced their bias into the process. I've told people, you let me pick the multiple and you let me pick the comparables, you let me tell my story. Because I'm going to pick the multiple that best fits my story. I'm going to pick the comparables that essentially make my story come true. You have to regain control of this process if you want to have any say in how something is priced. Any questions on the statistics? So think about that, the mean versus the median, and you'll see very quickly why when anybody talks about the average, you've got to stop them and say, what is the median value for this multiple? Because the average is probably not going to tell you much about that multiple. Until about, now as I said, I've been doing this for US stocks for 25 years. For the first 15 of those 25 years, I didn't do it for global stocks, partly because I didn't have access to global data. Capital IQ was a relatively recent addition to our arsenal here. So I used to use value line data to get US stocks. And then I'd go to Sao Paulo or Mumbai, and I'd present this US company distribution. And a grizzled veteran in the first row, an equity research analyst with 30 years standing, would put up his hand and say, well, it doesn't look anything like that in India. So how do you know? It's a gut feeling. And after about the 10th or 12th time of hearing somebody say, it's gut feeling, it's not like that in India and in Brazil, I said, you know what, I'm going to compute multiples across the globe. So starting about 12 or 13 years ago, I started computing these PE ratios, EV to EBITDA, the multiples across the world. And one reason I do it is to show how much we share in common. We talk about developed markets and emerging markets, informed markets and uninformed markets. You look across the distributions, notice they all look the same, peak to the left, tail to the right. I'm not saying there are not differences across. You look at the median PE ratios across companies, Clearly, at the start of 2015, the cheapest market to be in was Japan, if you looked at just the PE ratio. But again, don't go crazy and buy all Japanese stocks yet. And the highest PE ratio was in the US. At least based on PE, the US was the most expensive market at the start of 2015. Just to keep myself honest, I also computed the 25th and the 75th percentile to see if there are big differences there. But at least on PE ratio, you don't notice huge differences. One of the most interesting things here is emerging markets actually had a higher PE ratio than European stocks. For much of the early part of this process, when I first started doing this, emerging markets used to consistently have the lowest PE ratios across the globe. You say, why? They have a higher growth. Because the risk used to overwhelm the growth. In the last 4 or 5 years, you've seen emerging markets actually become higher priced, at least on average, than European stocks are. You can read whatever you want into that. It's a pricing game anyway. But you can see how these differences play out across time and across markets. Once in a while, though, those differences can lead you to ask why. I'll give you an example of a table that I looked at and say, this is different. This is price to book ratios, because you can do this with any distribution. Price to book, you're taking the market value of equity and dividing by book value of equity. And I computed the median values, and you can see across the globe, January 2013, the US was highest. In Australia and Europe were next. Emerging markets are slightly below. There's an outlier here, right? Japan looks like it doesn't belong even in this distribution. The typical Japanese stock trades at a price to book ratio of 0.67. You know why this is something it was worth doing before you start comparing across companies? Let's say you do a global comparison of 25 companies. 3 are from Japan, 7 are from the US, 8 from Europe, the rest are from emerging markets, and you put them in a table. The Japanese stock was going to look cheapest simply because it's coming from a market, for whatever reason, where price to book ratios are well below 1. Again, don't jump to the conclusion that this means Japanese stocks are cheap. That requires the rest of the analysis to follow. This is just your first look saying, hey, this looks interesting. This looks cheap to me. Now you have to ask the question, is it really cheap? One final use for these distributions. I am sick and tired of rules of thumb. If you've ever worked on Wall Street, you're surrounded by rules of thumb. 6 times EBITDA is cheap. 10 times earnings is cheap. If a stock trades at less than book value, it's cheap. A PEG ratio, I don't know who makes up these rules. I'm convinced it's some drunk banker in the late 70s leaving his office saying, from this day on, 6 times EBITDA is cheap, and it gets passed down as a ritual from banker to banker to banker. From this day on, 6 times EBITDA is cheap. Here's a very quick way to get rid of these rules of thumb. The next time somebody says 6 times EBITDA is cheap, rise to the challenge. Give them a list. You know what? Of every company that trades at less than 6 times EBITDA in the market. It's not going to be 10 companies. It's going to be 2,000 companies. You've got a nice list there. Get started investing. 6 times EBITDA clearly was not cheap. In January 2010, 6 times EBITDA was half the market. That's no definition of cheap. Maybe in January 2015, 6 times EBITDA might work. Unless you happen to be in Australia or Canada, in which case 6 times EBITDA gives you a lot of the market again. I understand why people use rules of thumb. It saves you time, right? You're in a hurry, you want to do something, a shortcut. I don't think you want to use absolute numbers anymore. 6 times EBITDA gets you into trouble because sometimes it's cheap, sometimes it's not. If you have the entire distribution, there's a much more flexible way in which you can get rules of thumb. Remember how I computed the 25th percentile of the distribution? You define what you tell me is cheap. Maybe you can say anything in the 50th or the 10th percentile is cheap. I can find for you with the distribution what the 10th percentile for that number is. And that will be your rule of thumb for the next 6 months. At the end of 6 months, I'm going to redo the distribution, and you recompute that. We shouldn't be stuck on these fixed rules of thumb, and the world is changing around us. So the first step in understanding multiples is looking at the distribution, getting a sense statistically of what that distribution is telling you. I think for a long time, our excuse was, we can't deal with all this data. We'll use the average. We'll use the median. We no longer have that excuse. We have the tools to work with the data. Think of this as sabermetrics brought to stocks, right? The essence of sabermetrics was For a long time in baseball, people computed batting averages or ERA, and they said a great pitcher is a low ERA and a great hitter is a high batting average. And what sabermetrics has brought, or Moneyball has brought to baseball, is that might not be enough. I care about whether you get on base, whether you get a hit and get on base or walk and get on base. It's still the same for me. I care about whether you come around to score runs. I care about whether you hit when there's a person on second base or whether you hit when there's nobody on base. The essence of sabermetrics is we have all this data we're throwing away. Let's use it to make better decisions. Think of it the same way with stocks. We're throwing away so much data. It's criminal. We need to bring that data into assessing stocks. So that's the first step in the process, is looking at all the data. Step number 2. As I said, every single multiple is embedded in it. All of the assumptions you're running away from in discounted cash flow valuation. So when you look at a multiple, here's the first question you're going to ask. What are the variables that drive this multiple? And I'm going to give you a very simple way of backing out those variables. And once you have those variables, you're home free. Because then you can ask, as those variables change, how will my multiple change? I'll give you a preview. We've been talking about PE ratios a lot, right? Low PE, high PE. There are only 3 variables that determine your PE ratio. Your cost of equity, your expected growth, and your payout ratio. See, how do you know? I'm going to show you the algebra to back it up. You give me EV to EBITDA, I'll give you the 4 variables that drive EV to EBITDA. You give me price to book, I'll give you the 4 variables that drive price to book. And the reason you need those is those are the variables you control for when you try to pick something based on that multiple. So what are the variables, and how, as they change, will my multiple change? Let me give you the very simple way you can back these out. I'm going to borrow from intrinsic valuation. I said we're going to leave it behind, but I'm not quite ready to leave it behind. I'm going to borrow from intrinsic valuation, not so much because I want to do intrinsic value, but because I'm trying to see what drives a multiple. So let's say I come to you with an equity multiple. You know what I mean? So PE ratio, price to book. Here's the way you can figure out what drives that multiple. Go back to the simplest equity intrinsic valuation model you can think of. The simplest one I can think of is a stable growth dividend discount model. It can't get any simpler than that, right? The value of a stock is expected dividend divided by cost of equity minus the growth rate. That's the value of the stock. If it's an equation, I'm allowed to divide both sides of the equation by a constant, right? So if I take the left-hand side, which is value, divide by earnings, I end up with a PE ratio. If I take the right-hand side and divide by earnings, the equation remains the same, but now I have an intrinsic value equation for the PE ratio. You have no idea what I'm talking about. I'll show it to you in the next page. Just plain algebra. You give me an enterprise value multiple, I can take an enterprise value equation, divide both sides by EBITDA, EBIT, whatever your denominator is, and I'll tell you what drives an enterprise value multiple. Enough with abstractions. Let's take the PE ratio. Simplest multiple, most widely used multiple in the world, right? Let me go back to a stable growth dividend discount model. Everybody recognizes it's called the Gordon growth model. Expected dividend next year divided by cost of equity minus the growth rate. I divide both sides of that equation by earnings per share. I'm allowed to do that. If I divide the left-hand side by earnings per share, I end up with a PE ratio. I divide dividends per share by earnings per share. What do I get? I get the payout ratio, right? So the PE ratio written in terms of intrinsic value is the payout ratio times 1 plus the growth rate, because I need next year's dividend divided by cost of equity minus the growth rate. It's true, though, that we are focusing on dividends, and when we talked about dividends, we talked about how many companies don't pay out what they can afford to in dividends. And we suggested an alternative. We said, why don't you look at potential dividend, which is the free cash flow equity? If you don't like dividends, just replace dividends with free cash flow equity, and you get a PE ratio in terms of potential dividends. So you can use that for an Apple, even though it doesn't pay dividends. So that'll be the payout ratio, the growth rate, and the cost of equity. If you can do this with a multiple, you've cracked the code for driving multiples. In a sense, this is for a stable growth company saying, oh, it's not going to help me. If I want to get the PE ratio for a Google, how the heck am I going to do it with a stable growth model? It's simple. Extend the algebra. The next page is going to look intimidating when I open it up, so I'm going to warn you before I do it, but then I'll explain what's on the equation, and you're going to find that the intimidation hopefully will fade. This is the PE ratio for a stable growth company. If you ask me to write the PE ratio for a high growth company, I told you the intimidation factor would kick in. This is what the PE ratio for a high growth company would look like. You're saying, I've never seen this equation before. That's actually a two-stage dividend discount model written as an equation. Okay? The first term in that equation is the present value of dividends during your high growth phase. It's the present value of a growing annuity. If you don't recognize it, that's the present value of a growing annuity. So if you tell me your dividends will grow at 30% a year for the next 10 years, the first term captures those. The second term is the present value of your terminal price. So what I've done is taken what we usually do on a spreadsheet and written it as an equation. Why do you want to do that? It's much simpler on a spreadsheet. There are reasons why mathematicians like equations. They're compact. So I could take a page that's 15 rows and 3 columns and make it into one equation. And here's the other reason. One of the questions I'd like to know the answer to is how, as a variable changes, will my multiple change, right? So what I did was I took that equation, divided both sides by earnings per share, and I have a PE ratio for a high growth firm. 50%, 80%, 100%, it doesn't matter. It's the present value of the dividends during the high growth phase plus the present value of the terminal price. So here's a question I have. One of the questions I'd like to know the answer to when I look at growth is, as growth changes in a company, how will the PE change? I know it'll go up, but how much will it go up? I know it's a long time in your school history, but remember calculus? I know we've tried very hard. I don't even remember very much of it, but I remember little glimmers of it. If you remember calculus, can you think of a way you can bring, don't worry, I'm not going to test you on your calculus, so relax. But can you think of a way in which I can use calculus to answer that question, how as growth changes will the PE change? What am I looking for? I'm looking for the first differential. I told you, don't freak out. I'm not going to ask you to write the first, but if you could write out the first differential of this equation of PE to growth, you can tell me exactly how much. You know, if you've forgotten your calculus, spend a few $100s by Mathematica. They have it at the bookstore. Put the equation in, it'll do the calculus for you. You can impress your clients to know, and you can create 3-dimensional graphs of how as growth and risk changes the PE change. Because basically, once you have the equation, you can answer that question. But I know we've all forgotten our calculus, including me. So I'm going to use a much more simplistic device to show you how as variables change, the PE will change. And here's what I'm going to do. I'm going to create a hypothetical firm, a hypothetical high growth firm that is expected to grow for the next 5 years. During those 5 years, here's what it's going to do. Its earnings are going to grow at about 25% a year. Its payout ratio is going to be low. Why? Because it needs to reinvest to grow, 20%, and that is a beta of 1. At the end of 5 years, this company becomes a stable growth company. I'm going to give it an obscenely high growth rate because risk-free rates were higher than 8%. Payout ratio 50%, beta 1. So it's a high growth firm, 5 years of 25% growth. And I ask you what the intrinsic PE ratio is for this company. Notice the word intrinsic. I'm not going to ask you to price the company. Just tell me, based on those fundamentals, what kind of PE ratio. What I did was I went back to the previous page and I plugged in the numbers. You have a 20% payout ratio, 25% growth, 11.5% cost of equity. That's a high growth phase. 8% growth, 50% payout ratio, 11.5% cost of equity. Stable growth phase. I plugged the numbers in. I came up with 28.75. Saying, what does that even mean? If the stock were priced the way the fundamentals suggest it should price, use a stable growth, using a dividend discount model, it should trade at 28.75 times earnings. That's a pretty high PE, right? But why is it so high? Because I expect this company to have high growth in the future. We've all made this mistake of investing in a high growth company because we think it has high growth and waking up to a nightmare, which is we wake up tomorrow and the company turns out to be a low growth or a no growth company, right? It can happen. So let's say you pay 28.75 times earnings for this company because you believe it'll grow at 25%. But tomorrow you wake up to a realization that the growth rate is not going to be 25. It's going to be only 20 or 15 or 10 or 5. First, give me a sense of direction. What's going to happen to my PE? Is it going to go down or up if my growth rate tomorrow drops? It's going to go down, right? So here's what I did. I took this equation, kept everything else, and that's the nice thing about a hypothetical company. I can hold everything else constant, and I looked to see what the PE ratio for this company would be if its growth, instead of being 25%, turned out to be 20, 15, 10, or 5. Or at the other end, I got a higher growth rate. No surprise here. As my growth rate decreases, my PE decreases. As my growth rate increases, my PE increases. You're saying, why are there 4 columns? I looked at 4 interest rate scenarios. 4%, 6%, 8%, 10%. In fact, I should probably have added a 2%, which is where we are right now. Under every interest rate scenario, as growth decreases, the PE decreases, right? But I'm going to ask you a follow-up question here. While PE decreases with growth in every interest rate scenario, under which interest rate scenario am I most sensitive to changes in my expected growth rate? A low interest rate scenario or a high interest rate scenario? The low interest rate is the blue. The high interest rate is the green. So as my interest rates go up, am I getting less sensitive to changes in growth rate or more sensitive? It looks like I'm getting less sensitive, right? Why is that happening? Why do I care less and less about expected growth as my interest rates get higher and higher? What's the value of growth? It's all in the future, right? As interest rates go up, what happens to the value of growth? It gets smaller for any given growth rate. In fact, let's put ourselves in an extreme scenario. Let's say we were in Brazil in 1991. Interest rates are now at 5,000%. That's actually what the interest rates were in Brazil. What's the value of growth if interest rates are 5,000%? Close to 0. What if I surprise you and tell you that I'm going to have twice the growth that you say, I don't care. Half the growth, go away. When interest rates get really high, the value of growth pretty much disappears, and all I'm paying for is what's on the ground right now. Conversely, as interest rates get lower, the same growth rate becomes more valuable. A bigger and bigger chunk of your value comes from future growth. Do you see the real world implications? Are we in a low interest rate environment in the US or a high interest rate environment right now? We're in a low interest rate environment. What does this graph tell you about earnings surprises? What's an earnings surprise? It's not what you're learning about earnings last year that causes a surprise. It's what you're learning about future growth. So when you get a negative surprise, like GoPro delivered a week ago, it's not what you learned about last year that's critical. It's what it's telling you about future growth. And what does this graph tell you? That same surprise is going to have a much bigger impact in either direction. So when Google announces better than expected earnings, you should see its stock price jump a lot more than you would have 10 years ago. If GoPro announces lower earnings than expected, it should drop a lot more than you expect it to. It's a steroid effect of low interest rates. And what it's going to mean is earnings announcements will have much bigger impacts on stock prices now than they did 10 or 20 years ago. Get used to it. So rather than every time this happens, throwing up and saying, oh my God, markets have become more volatile, recognize that this is the downside of having low rates. A small surprises in either direction will translate into much higher volatility. Any questions on that? The next what if I asked was, I used a beta 1. I said, what if my beta 1.25, 1.5, 1.75, 2? Again, no surprise. As I hold all else constant, I increase the riskiness of the stock, the PE ratio comes down. But again, let's make this real. Let's assume I am the CFO of a really risky high growth company. In fact, let me give myself characteristics. I have a beta of 2 and a growth rate of 20%. So right now, I'm trading at 7.5 times earnings. You're my advisor. I come to you with a question. I have 2 choices and they're mutually exclusive. I can go for more growth. In which case, where am I stuck? I'm stuck in this last section. Or I can say, look, I'm not going to focus on growth. I'm focusing on reducing risk. If I reduce risk, what happens? I'm moving across the graph this way. Which do you think is a more productive choice for me? To go for more growth or to reduce risk? At least in this graph, reducing risk is going to have a much bigger payoff than going for more growth because I can move across the graph. You see, that's so obvious. Think of how many growth companies get focused on growth, still more growth, yet more growth, when the markets change around them. We've talked a lot about Amazon from an intrinsic value standpoint. Stock prices right now are close to 650. But here's one thing about Amazon that I think has never been given, they've never been given credit for. In those days in 2001, when people were holding their breath saying, will Amazon survive? While other high-tech companies kept going for more growth, in a world where everybody was worried about risk, What you got to give Amazon credit for is they lowered their growth expectations and they started talking entirely about risk. They knew the game had changed around them, and they changed when the game changed. Think about it in this context. They decided the payoff to reducing risk was much greater. That's what they focused on. And 15 years later, they've lived, not just lived to tell the tale, but they've lived very prosperously to tell the tale. And that's something companies often forget, is the price of risk and the price of growth keep changing. You have to adapt to those changes. I'm sorry. So let's use this, right? So at this stage, I'm going to play a little game, and I'm going to do this with every multiple. When I ask you about a stock or a market with a low PE, you have to ask three questions. What is the risk? What is the growth? What is the efficiency of that growth? So somehow if you can answer those questions, you can tell me whether a low PE or a high PE is good for you. So I'm going to start easy. I'm going to play the role of an analyst presenting markets to you, and you tell me what I'm missing with my recommendation. So I'm a global market strategist. What do? Spew out bullshit like it's going out of style. That's what global market strategists do. They have no idea what they're talking about, but they sound really good while they're saying it. So in March of 2014, I tell you that Russia looks cheap. Why? Because look at the PE ratio. It's trading at 4 times earnings. It's a very simple, as I said, we're going to start easy. What am I missing? It looks cheap, but remember, there are only 3 questions to ask me, right? The risk is astronomical. And this was before they invaded Ukraine, right? The risk is astronomical. Who knows what the cash flows are? It's so opaque, you have no idea what the cash flows are. And if you don't know what the cash flows are, you have no idea how efficiently the growth is being delivered. No surprise here. So obviously you can't compare PE ratios across markets, otherwise you'd be loading up in Venezuelan, Russian stocks as if they're going out of style. So let's be a little more focused when we look across companies or countries with very different characteristics. So let me go back about 15 years and show you some numbers I pulled up for some emerging markets then. So a bunch of emerging markets, I pulled up the PE ratios for these markets. I also pulled up 3 other numbers. The level of interest rates in the local currency in each market, the real growth rate in GDP in each market, and a measure of country risk that I pulled from The Economist. And the way to read this measure is the lower this number, the less country risk there is. So let's start easy. Holding all else constant, as interest rates go up, what should happen to PE ratios? Higher interest rates, lower PE ratios, right? Because of multiple. As holding all else constant, with higher real growth, you should get higher PE ratios, and holding all else constant with higher country risk, you should get lower PE ratios. Now, the problem with saying that is, now how do I control for it? I opened up my statistics textbook. The dust fell out of every page. I got to that section on multiple regressions. Remember that section? Multiple regressions, your objective is to explain a dependent variable, in this case PE ratio, with independent variables, variables that you think drive that dependent variable. I'm going to push the limits of my sample. My sample is pretty small, and I should not be using this many independent variables, but let me break that rule. So what I did was I took those countries, and I ran a regression of the PE ratios of these countries against interest rates, growth, and country risk. Let's see if the science makes sense, because they don't have to. It's a data, it can be whatever it is. As interest rates go up, PE ratios go down. Makes sense, right? As growth in GDP goes up, PE ratios go up. Makes sense. As country risk goes up, PE ratios go down. Again, makes sense. Don't get too used to that makes sense, because as we run these regressions, you're going to find sometimes it will not make sense and you can't find the data. The data is what it is. The R squared is 73%, and again, don't get too excited. It's a small sample, and all you need is a couple of outliers for the R squared to get pushed up. But I'm happy it's at least a big positive number. Now, why am I running this regression? Because I want to find out which of these markets is cheap and which is expensive, right? Is there a way I can use this regression to answer that question? What am I going to do? I'm going to go back and I plug in each country's interest rate, GDP growth, and country risk into the regression. I'm going to get a predicted PE for each country, right? So I got a predicted PE. Now what do I do with the predicted PE? I compare the predicted PE to the actual PE. Rather than compare PE ratios across countries, I'm going to compare each country's PE ratio to what I predict that country's PE ratio to be. So let's start at the top. Argentina looked cheap, 14 times earnings. But after I control for its really high interest rates and really high country risk, its predicted PE is 13.57, making it cheap or expensive? It's actually expensive relative to what I'd want it to be. And I do that for each country. At the end of the process, I'm going to be looking for which countries have actual PE ratios significantly below their predicted PEs. Those are my cheap countries. And what countries have actual PE ratios much higher than the predicted? Those are going to be my expensive countries. And if I truly have faith in my regression, what am I going to do? I'm going to buy the cheap countries, sell short on the expensive countries, and hope and pray that everything moves to my regression line. That's very simple quantitative techniques brought to looking across markets. So if you're interested in looking across markets, try this out. It's very easy to do in today's markets. The data is there. You can pull it off Bloomberg. You can pull it off S&P Capital IQ. You can pull it off my website. And start looking at differences across countries and seeing what you can or cannot explain. This is actually already dated, so I'm not going to spend too much time. But this is exactly what I'm talking about, where the PE ratios are very different across countries. And you're saying, given what I know about these countries, does it make this country cheap? And it's not going to be as simple as going to the lowest PE ratio country and saying, I'm going to put all my money in it, because there might be very good reasons why the PE ratio is what it is in that country. Okay. So this was after the Russian invasion of Ukraine. Somebody did this because emerging markets were in turmoil. But you can create your own, more refined version of this, where you look at actual PEs and compare to what the PE ratio should be for that country. The one thing is you can't use ratings as your measure of country risk, because you can't run a regression with ratings. Ratings are not numerical. So you have to somehow come up with a country risk score that is numerical. And if you're interested, I'll be glad to give you some suggestions on where to get them. But if you can get them, you can start seeing why some countries, even though they have low PE ratios, might not be countries you want to invest in. Because after you control for the risk and growth differences, they no longer look cheap. Let's take another comparison. This is with just the US markets. Rather than comparing across countries, now I'm going to compare across time. What this is a graph of the PE ratio for the S&P 500 going back to 1960. Seeing why there are three lines? I computed three different PE ratios. The first is my regular PE. Regular PE, I take the level of the S&P 500, the earnings in the most recent 12 months. I compute a normalized PE. What is that? I take the price today and I divide by the average earnings over the last 10 years. Why am I doing that? Because earnings tend to be volatile. The third, I do what's called a CAPE, which has become this big buzzword in investing. CAPE, what I do is I take those 10 years of earnings, and because there's been inflation, I inflation adjust those earnings. First thing you notice about the three lines is they all are pretty close to each other, right? In fact, from going from PE to normalized PE to CAPE, I've done barely nothing. So why do I do it? Because it looks more sophisticated, right? You adjust, you've done inflation adjusting. So the first thing to remember when somebody talks about these PE ratios, at least in the US, there's not much difference across the three in terms of time series. So I'm going to play the role of a market strategist, and I'm going to throw a recommendation at you. And again, I want you to use what you already know about PE, and you know more than enough to ask me the right questions. So here's my recommendation. I look at the PE ratio today. The PE ratio January 2015, whichever definition you use, 18 times earnings, 24, 21, 22, all look high relative to the average for those numbers over the last 30 years, or the last 50 years. So I say, you know what? Stocks are overpriced. The CAPE today, the PE today, the normalized PE is much higher than it's been historically. So far, half that statement is absolutely true. The PE today is higher than it's been historically. Can I jump to the conclusion that stocks are expensive today simply because the PE today is higher than it's been historically? Ask me the three questions. First, the cost of equity, right? And what goes into cost of equity? A risk-free rate. So the first thing I have to ask is, hey, risk-free rate 20 years ago was 5%, 30 years ago was 7%, today it's 2%. How can we compare PE ratios across time when the risk-free rate is changing? The second question you're going to ask is about growth. Is earnings growth today higher, lower, the same than it was 20 or 30 years ago? And the third thing you probably want to check is what kind of return on equity do you... I'm not saying that your story cannot be true, but until you ask those three questions, you really can't even decide whether stocks are cheap or expensive. So a market strategist says, look, stocks are cheap today or expensive today based on comparing PE ratios across time. He's told you about 1/4 of the story. And until he fills in the remaining 3/4, it's just a story. And I don't care if the market strategist has a Nobel Prize next to his name. Because this is a Robert Shiller bubble argument for the last 4 years. A brilliant man, but he's basing it on one ratio without controlling for big differences in the underlying variables. So don't be intimidated by the fact that people come in with these credentials. Oh, I've done this for 30 years. I'm a great market strategist. If you're basing your comparison on one metric like PE without controlling for those differences, you've told me absolutely nothing about whether stocks are expensive or cheap. So I'm going to try something. I'm going to invert the PE ratio. You know what I mean by invert? Rather than look P over E, I'm going to look at E over P. It's called the earnings yield. And the nice thing about the earnings yield is now I can put that right against the T-bond rate. See these two lines? The earnings yield is the kind of ugly, whatever color that is, yellow line, the gold line. The T-bond rate is this blue line. Without doing any statistics, you look at those two lines, what do you notice? An awful lot of the time they move together, right? When one goes up, the other goes up, and the other one goes down. I also added a third series into this graph. And the third series actually looks at the difference between two numbers, the T-bond rate and the T-bill rate, the 10-year T-bond rate and the 3-month T-bill rate. So what am I capturing when I look at that difference? If that number is 0, I have a flat term structure. If that number is a big positive number, I have an upward sloping yield curve. And if that number is a negative number, I have a downward slope. You're saying, why should I care? At least historically, the slope of the yield curve seems to have some implications for how stocks are priced. Okay? In fact, what I did was I ran a regression of earnings to price ratios. This is just the S&P 500 across time. So it's a cross time regression of earnings to price ratios against the T-bond rate and the T-bond rate minus the T-bill rate. And here's what I found. Every 1% increase in the T-bond rate increases my earnings to price ratio by 0.57. Remember to invert that in your head. When the earnings to price ratio goes up, the PE ratio goes down. Next time you hear this big discussion about the Fed, this is what it's really about, right? Because if the Fed raises rates, and we've raised questions about whether it can do it. Let's say your expectation is over the next year, T-bond rates are going to rise by 1%. Holding all else constant, earnings to price ratios are going to go up by 0.57%, which is going to push down the PE ratio by about 3. Which is a pretty substantial drop, right? 21 to 18, that's going to be about a 15% adjustment, holding all else constant. And that's where things get tricky. If you really believe the Fed has the power to raise rates, carry that true story to its logical limits. Under what conditions is the Fed likely to raise rates? If it believes growth is going to be high or growth is going to be low? If it believes that growth is going to be high. So the conditions under which rates are going to go up are also going to be conditions where growth is going to be increasing. That's why it's almost impossible to ask these what-if questions, because you need to know what drives the change in rates. Is it a change in inflation? Is it a change in growth? Is it a change in return equity? That's what's ultimately going to determine whether PE ratios are going to decrease, increase, or stay the same over the next year. You see, this is incredibly complicated. I agree. That's why I'm not a market timer. There are too many moving parts that you really can't control. And to make judgments based on a PE ratio for the entire market is asking for trouble, no matter how good your credentials are as a market timer. One interesting thing that has happened is if you look at this regression, the R squared is about 41%. Regression of earnings to price against the level of interest rate. In 2008, when I ran this regression, the R squared was 51%. Over the last 6 years, the connection between earnings to price ratios and interest rates has become much, much weaker. That's a scary thing. You know what? Because that connection is what keeps the Fed's power alive, right? If the connection weakens, the Fed's power over stock prices, over the economy, essentially have also weakened. So while we get all this talk about the Fed and how much it affects prices, the underlying dynamics are such that the relationship between interest rates and earnings to price ratios has become weaker over the last 6 years. than it was prior to that period. And that's something to watch as we see this process plays through. So that's a PE ratio you can already see. You can expand it. The variables that determine it are cost of equity, growth rate, and payout ratio. Now, one of the problems with PE ratios is, of course, in comparing it across companies, high growth companies will tend to have high PE ratios. I was just checking the PE ratio for Amazon. You know what it is right now? It's about 939, depending on your measure of earnings, 900, 850. If you just look at this, that's too high. And that number, of course, is unexplainable. But if you're comparing companies with low growth and high growth, you should expect to see 50 times earnings and 7 times earnings in the same sector. And this drives analysts crazy because they want to use one metric to pick stocks, and if PE doesn't work anymore, so what do I use instead? So in the tech sector especially, where growth rates tend to vary across companies, here's a ratio that analysts invented. Based, I think, initially on Peter Lynch's books on Beat the Market that he wrote about when he was running for Dow Magellan. So what analysts have started doing is dividing the price-earnings ratio by the expected growth rate. Let me explain. Let's say your price-earnings ratio is 20, and your expected growth rate for the next 5 years is 15. 20 divided by 15 is 1.33. That's called a PEG ratio. You're saying, what does that tell me? If you compute this across companies, you're looking for companies with low PEG ratios, where the PE ratio is low relative to the expected growth rate. And what it lets you do then is pick companies with PE ratios of 50 if the growth rate is 100%. So it sounds simple, right? But the rationale for doing this is analysts think that by doing this, they no longer have to control for differences in growth if you use a PEG ratio. Let's see if, in fact, that is true. So I took the original two-stage. Obviously, you've got to have a high growth dimension, otherwise the PEG ratio doesn't even work. And I did the algebra, and it was painful to do because I had to first divide by earnings and divide by growth rate. The bottom line is when I finished, the one thing I noticed was that growth did not go away. Because if that's the objective for using PEG ratios, G should not show up in the equation. Instead, it shows up everywhere in the numerator. If nothing else, you've made this relationship incredibly complicated. PE and growth, at least I know which direction to move. PEG ratios and growth, the equation completely becomes messy. But I'm going to use that hypothetical company to talk about this. But basically, the two things that you get out of the equation is, if you're doing this to make growth go away, dividing price earnings by growth, it's not working. Growth is still there. The second is the other two variables, risk and payout, continue to affect your PEG ratios. Riskier companies will have lower PEG ratios than safer companies. Companies that can deliver higher returns on equity will have higher PEG ratios than companies that don't. So what I'm going to do is I'm going to go back to that hypothetical example. Remember the company I created for my PE ratio? And try to compute the PEG ratio for this company and look at how that PEG ratio changes as my fundamentals change. So same company, 25% growth rate, 20% payout ratio, beta 1. I compute the PEG ratio, and the PEG ratio that I get for this company is 1.15, which actually is the 28.75 divided by 25. So no surprise there. By itself, if I stop there, nothing interesting has been learned. So what I did was I took this company and I changed one thing at a time. So I'll start easy. When I change my beta, here's what happened to my PEG ratio. Same growth rate. My PEG ratio goes from a PEG ratio of 3 down to a PEG ratio of 0.4. Riskier companies will have lower PEG ratios than safer companies. I've actually seen high-tech equity research reports where the analyst has taken the PEG ratio for his company, Adobe Software, and compared it to the PEG ratio for the S&P 500. And come to the conclusion, Adobe looks cheap because its PEG ratio is lower than the PEG ratio for the S&P 500. You see the flaw in the reasoning? Adobe is much riskier than the S&P 500. It should have a lower PEG ratio. So if you're going to compare PEG ratios across companies, make sure that the risk in these companies is roughly the same. I also looked at what happens if I kept everything else constant, increase the return equity, which is the same thing as increasing the retention ratio. Again, no surprise. If I have higher returns in equity, I will have higher PEG ratios. So if I'm comparing 25 companies, I would expect the companies with the highest returns in equity to have the highest PEG ratios because they're delivering growth more efficiently. And then I have a graph that scared the living daylights out of me because if I'm using PEG ratios, this is the graph that I should be worried about. I changed the growth rate. Remember the PE, as I changed the growth rate, the PE always went up as the growth rate went up. Here initially, as the growth rate went up, my PEG ratio decreased. So you're saying, I'm learning, so as growth rates go up, PEG rate. But then it got to a point where it started moving back up. You have a U-shaped distribution, and the reason that's troublesome is we don't do the algebra, right? We control for variables, and we try to find cheap stocks by looking for the perfect combination. Let me explain. If I ask you to find the perfect cheap stock with PE ratios, help me out here. I want a low PE or a high PE? I'm looking for a cheap stock. I want a low PE. I want low growth or high growth? I want high growth because low growth would, so you want low, you kind of get where I'm going, right? You want low PE and high growth. You want low risk or high risk? Low risk. So low PE, high growth, low risk. You're naturals at this now. Low return equity or high return equity? So basically you want a stock with a low PE, high growth, low risk, and a high return equity. You say, what chance do I have finding something like that? No harm looking. There are 7,887 companies, right? That's the essence of screening. You're looking for companies low PE, high growth. Try that. Go on Capital IQ. So with PE, it's easy. You know exactly. Now let's try this with PEG ratios. You want a cheap stock with a PEG ratio. You want a low PEG ratio or a high PEG ratio? Got that 50-50 chance, but that was the wrong choice. Okay, so let's try again. Low PEG ratio, high PEG ratio. You want, depending on what you said, you're reversing the answer. It's a low PEG ratio. Just like PE, you want a low PEG ratio. You want the lowest PE. So let's assume you got that right. So you got the low PEG. You want low risk or high risk? You want low risk because a high risk will, so you want low PEG ratio, low risk. Low return equity, high return equity. You want a high return equity. Now comes the tricky one. Low growth or high growth? Now do you see why it's troublesome? Because there is no way to answer that. This is exactly why I think PEG ratio should be banished and never allowed to come back again. They're horrible multiples because it's impossible to tell a cohesive story. In fact, a lot of people who use PEG ratios use them because they think it makes it simple. They've actually made their lives a lot more complicated with PEG ratios because they're so difficult to control for. By now, I hope you're getting the way we're approaching. With every multiple, what do? We go back to the algebra, not because we want to compute intrinsic value, but because it tells us what questions to ask. So we've done PE, we've done PEG. Let's move on to price to book. Equity multiple. So I go back to a dividend discount model. I divide both sides of the equation by book value of equity. I end up with an equation for the price to book value for a company. And it's determined by 4 variables. The cost of equity, the expected growth rate, the payout ratio, and notice the 4th variable that popped up when we did price to book? The return equity. Every multiple has what I call a companion variable. So what do you mean? This is the one number I need to know to use this multiple. So if somebody called me and said, hey, I have a cheap stock, it's trading at half of book value, the first question I'm going to ask that person is, what's the return equity of this company? And 90% of the time, the answer is going to be it's either negative or it's very low. Most companies that trade at abysmally low price to book ratios have low returns on equity. So those are the 4 variables I have to control for. In fact, if I wanted to simplify this further, I can use that fundamental growth equation where growth is equal to retention ratio times return equity. I end up with an equation for price to book. It's actually a very useful equation if you're in a hurry. The price to book value for a company is return equity minus growth divided by cost of equity minus growth. That's it. So what types of companies trade at above book value? What's got to be true about the return equity relative to the cost of equity? The return equity is higher than the cost of equity, the price to book will be above 1. If my return equity is equal to my cost of equity, my price to book value is going to be roughly 1. If my return equity is less than my cost, it's as simple as that. So the next time you see a low price to book stock where it's trading at below book value, check out the return equity. That return equity has to be lower than the cost of equity in the long term for that price to book to be a decent value for this company. So those are 3 equity multiples, right? Just to change the metric a little bit, let's look at how this multiple would be computed if I did enterprise value. Now we're not looking at market value of equity and book value of equity. I'm looking at market value for the entire firm divided by book value for the entire firm. Very simply put, if you ask me for a value to book ratio, not a price to book, value to book, as in value for the company divided by the book value of the entire company, it looks very much like the return equity equation, right? So return equity, the only difference instead of return equity, I focus on return on capital instead of cost of equity. I do cost of capital, and exactly the same relationship applies. If a company earns a return on capital that exceeds the cost of capital, its enterprise value will be higher than its book value. If its return on capital is equal to the cost of capital, they should be roughly the same. If it's less than the cost of capital, it should trade at below book value. It's an amazing number of equity research reports that are based on a very simple argument. If a stock trades at less than book value, it must be cheap. You see how dangerous that argument is? It's built on this presumption that book value actually is equal to liquidation value. And it's not. The two have nothing to do with each other. So you have about 2,000 US companies that trade at below book value. 2,000 out of the 7,887. I would not touch 1,950 out of those 2,000 companies because they deserve to trade at below book value. The key is how do you separate the 50, and that's basically where the questioning will lead you, is to find those 50 companies that don't deserve to trade at below book value. So we looked at price earnings, PEG ratios, price to book, enterprise value, invested capital. By now, hopefully, the algebra is starting to make sense in terms of why we use one multiple than the other. Let's look at enterprise value to EBITDA multiples. Enterprise value to EBITDA is, because it's a firm value multiple, I went back to a firm valuation model, where the value of the firm is free cash flow of the firm divided by cost of capital minus the growth rate. I rewrote the free cash flow to the firm in terms of EBITDA. It makes my algebra a little simpler. So though normally we think of EBIT times 1 minus T, I just rewrote it as EBITDA times 1 minus T, then subtracted out the DA. And then I divided both sides by the EBITDA, and I end up with an equation for the EV to EBITDA multiple. Don't be intimidated by the number of terms. Here's what drives your EV to EBITDA. The EV to EBITDA for your company is a function of your cost of capital. Companies with higher costs of capital will have lower EV to EBITDA multiples. It will be driven by expected growth rate. Companies with higher growth rates will have higher EV to EBITDA multiples. It will be driven by your tax rate. The higher your tax rate, the lower your EV to EBITDA multiple. How come tax rates never showed up when I did price earnings ratios? Why didn't I care about tax rates? Because net income is already after taxes. If you pay a high tax rate, it's already in your net income. The minute you start climbing above your taxable income to EBIT or EBITDA, you have to ask what's the tax rate, because it makes a difference to you whether your tax rate is 50%, 30%, 10% or 0%. So Pfizer's PE might not change if it becomes an Irish company, but its EV to EBITDA will change if it becomes an Irish company. That's kind of a strange thing to say, but that's basically the way to think about any multiple of pre-tax income as your tax rate matters. And finally, it depends on what you're reinvesting to get the growth rate, which is the equivalent of saying what's your return on capital. So if I'm one of those PE guys who says 6 times EBITDA is cheap, those are the questions you need to ask me. What's your tax rate? What's your return on capital? What's your growth rate? And by the time you're done with those questions, you will have a sense of whether 6 times EBITDA is cheap or expensive. And that's really what this process is about. It's not about the intrinsic value algebra. It's about asking the right questions. So here's a simple example. I took a company with a tax rate of 36%. CapEx was 30% of EBITDA. Depreciation was 20%, a cost of capital of 10%. Just for simplicity, I left out working capital. I made it 0. And I said it's in stable growth, growing 5% a year. I plugged in the numbers. I came up with an intrinsic EV to EBITDA for this company of about 8.25. Then I asked, what if the tax rate changes? What if the return on capital is different? And again, no surprises. If I hold all else constant, my tax rate goes up, my EV to EBITDA will get lower. So if I'm comparing 10 telecom companies in Europe, I would expect the Irish telecom company to look most expensive. Why? Because given the tax rate, you'd be willing to pay a much higher multiple of EBITDA in Ireland than in Germany. So when you're comparing across countries, especially in EV to EBITDA, control for taxes. Control for what the company is reinvesting. That same growth rate is worth more if you can get there with less reinvestment rather than more. And if you think in terms of return on capital, high return on capital should trade at much higher multiples of EBITDA than low return on capital companies. A third of all equity research report globally now is based on EV to EBITDA. My suggestion is walk into any investment bank or go online and see if you can download an equity research report built on EV to EBITDA. Check to see if the analyst is asking the right question, because that's all you can do, right? Use EV to EBITDA. They're asking about taxes. They're asking about return on capital before they conclude that a stock is cheap or expensive, because without doing that, you haven't done your due diligence. Which brings me to my final multiple, revenue multiples. So let's do a EV to sales. Again, the consistent multiple. Then we'll talk about what's different about price to sales. So again, if you write the EV to sales multiple, and you'll have to trust me on the algebra if you don't, so I used a two-stage model. That's what the EV to sales ratio for a growing firm is. It's a function of return on, in this case, because I'm using an EV multiple, it's a function of my cost of capital, my growth rate, my reinvestment rate. See that variable in the outside? The operating margin. Companion variable for revenue multiples is the margin. I'll give you a very simple trick on finding your companion variable. I know this is late in the class, you're probably not going to quite grasp the trick, but take it down anyway and think about it. If I give you an equity multiple, the companion variable is always going to be net income, okay, divided by the denominator of your multiple. Just take it down for the moment, then I'll throw a few equity multiples. So if I give you an equity multiple, the companion variable is net income divided by the denominator. So let's try this. Price to book. Market value of equity divided by book value of equity. What did I say the companion variable is? Net income divided by the denominator. So net income divided by book value of equity is return on equity. Price to book ratio, net income divided by book. If I gave you price to sales, bad multiple, but stick with it, your companion variable is going to be net income divided by sales, which is net margin. You think it won't work with price earnings. Net income divided by net income is 1. But what if I took net income in the future and divided by net income today? I get expected growth. Price earnings, the companion variable is growth. EV to invested capital, or any EV multiple, take after-tax operating income and divide by the denominator of your multiple. EBIT times 1 minus T. So let's try EV to invested capital. EBIT times 1 minus T divided by invested capital is return on capital. EV to invested capital, the companion variable is return on capital. EV to sales. After-tax operating income divided by sales is after-tax operating margin. It's a very simple way. You're in a hurry, you want to come up with the companion variable. Try it out. It's amazing how often it'll give you that one number you need to know to use this multiple. So let's try this. Okay? In fact, I'm going to use it to answer a question that is a question that in marketing classes we wrestle over. I haven't been in a marketing class in a long time, so I shouldn't say we, you wrestle over. What's the value of a brand name? And we dance around these things, we throw buzzwords out there. The essence of a brand name, and I'm sorry if I sound simplistic for those of you who are marketing mavens, the essence of a brand name is you get to charge a higher price for exactly the same product. That to me is the power of a brand name. And I might have used this example before, but I'll use it again. If you want to see brand name at play, walk into a CVS. Walk down the painkiller aisle, stop in front of the aspirin section. And you're going to see all these bottles of aspirin. You're going to see Bayer aspirin. I checked this price, I was $2.39 for 50 tablets. Right next to it, you see CVS aspirin. 50 tablets for $1.29. If you're suspicious, check out the ingredients. What are you going to see? Exactly the same thing. And then think of how often you buy the brand name. The Sudafed instead of the CVS version. Why? Because that's what brand name does. It plays with your brain. It makes you pay more for the... And don't fight it. That's what these companies have spent hundreds of millions of dollars in whatever accidents of history have led them to where they are to be able to do that. So if somebody asks you what the value of a brand name is, there's a very simple way you can focus it. Because it comes through pricing power, right? Pricing power shows up where? It shows up in your margins. So if tomorrow you lost your brand name, what's going to happen? You're going to lose pricing power. Your margins are going to compress. Thank God I'm not an accountant, because accountants now have to face this question of what's the value of a brand name. But if I were asked to value a brand name, that's how I do it, is I'd value the company twice. Once with the brand name and the pricing power, and once without. The difference is the value of a brand name. So I'm going to take a company that gets almost all of its value from its brand name. So guess who it's going to be? Coca Cola. Because let's face it, soda is soda. It's crap and sugar and water with a bunch of, it's syrup, who cares about it? But it's Coca Cola, one of the most, for a long time, it was the most valuable brand name in the world. And this was actually about probably 10 years ago. I was asked to come into Coca Cola and talk to their top management about the value of the company, the value of the brand name. So I went in and I did a traditional discounted cash flow valuation, which is in the first column, by using cash flows and growth and everything we've talked about in this class. An intrinsic value of about $79.6 billion. So I finished my value, and the guy in the front row, the marketing head honcho for Coca Cola, puts up his hand and he says, "You forgot something very important." I'm saying, "What did I forget?" Maybe a whole division, maybe a business that I didn't know about. I said, "What did I forget?" He said, "You've forgotten the fact that Coca Cola is the most valuable brand name in the world." So what exactly do you want me to do? He said, "You should be adding at least 20% to that $79.6 billion. I said, "Why?" Because he said, "That's what we at Coca-Cola do when we buy brand name companies in other countries, is we value them and then we add 20%. He said, "Just because you do stupid things doesn't mean I have to do stupid things too." He said, "Don't you think our brand name is worth a lot?" I said, "It's worth an immense amount. But it's already in there." He said, "In where?" "Everywhere. Why do you think you're earning the margins that you are? Do you think your soda actually tastes better?" They thought, remember in the 1980s, there was this brief period of insanity where they actually thought it was about taste. And they went through this dance of new Coke, old Coke, before they decided nobody cares what it tastes like. I said, "You got a margin which is insane, a 16% margin because you sell syrup. In fact, that doesn't even cost you anything. It's all the marketing on top of it. That 16% margin gives you a return on capital of 21%, which gives you a growth rate of 10.4%, which gives you a value of $79.6 billion. He said, "I don't believe you." Thank God I came prepared, because I knew this question was going to come up. And this time I got lucky. I said, "Okay, let's play a game. Let's assume tomorrow we woke up with selective amnesia, the entire world, and the only thing we've forgotten is the word Coca-Cola and the red can that goes with it. This is every marketing person's nightmare. Let's make it come true." So tomorrow you wake up, you've lost your brand name, you've lost your pricing power, you become a generic soda company, right? And here's where I got lucky. I found a company called COTT, C-O-T-T. It's a Canadian company. You've never heard of it, but the reason you never hear of it is they don't put their names ever on their sodas. You walk into a Pathmark or a Grand Union or one of the supermarkets, you buy one of those generic sodas, take a look at where it's made. COTT makes a surprisingly large percentage of these generic sodas. They let the supermarkets put their own names on it. It's a generic soda company that spends nothing on advertising, because what are they going to advertise? Their name never shows up. Their margin is 5.28% because they have to sell at these paper-thin prices. I said, tomorrow if Coca-Cola loses its brand name, but is able to continue to sell all the soda that it does today, and it's lost its pricing power, the 15.57% becomes 5.28%, which in turn translates into a lower return on capital, lower growth rate, and a value of $15.4 billion. You want me to give you a brand name value? Well, I just did. In fact, based on my valuation, the brand name value for Coca-Cola is the difference between those two numbers, which is $64 billion. Don't ask me at a 20% premium for this. If you've done a valuation right, it should already be in there. There should be no premiuming or discounting needed here, because it's already built into your numbers. And if it's not built into your numbers, it's because you did not do the valuation right. You say, what if I don't have pricing power? Then don't talk to me about your brand name. About 80% of companies that talk about brand name have no business talking about brand name. I remember doing this for a group of marketing people. It's actually for Scott Galloway's luxury brand, bad audience to try this out on. One of them put up his hand and said, "Well, with this approach, Walmart doesn't have a brand name." I said, "That's exactly right. Nobody walks into Walmart and says, 'It's a Walmart product, I'll pay 20% more.' Walmart has a different, this is not the only competitive advantage in the world. Walmart's competitive advantage is what? Cost savings. Don't act like this is the only competitive advantage. There are lots of great companies out there which have no brand name power. In this case, though, much of the value for Coca Cola comes from brand name, which also means what? If you're managing Coca Cola, what should you care about most? Preserving the brand name. Forget about taste. Don't let the wrong people be your spokespeople. No Lindsay Lohan ads for you. Okay? That says you don't want 3/4 of your value resting on somebody you can't trust. But everything you do has to be driven for preserving that brand name, because that's where your value comes from. This was easy to do with Coca Cola. It's much more difficult to do with many other companies. In fact, last year, according to Interbrand, a company that has no idea how to measure the value of brand name, but they value it anyway and rank companies, the company with the most valuable brand name in the world was Apple. You know how difficult it is to estimate the value of brand name in Apple? You think it's pricing power, but when you take the difference in pricing power, you're valuing brand name, what else is in there? The operating system, there are all these other factors. It works best when you have a company where the only thing causing pricing power is brand name. It gets much messier when there's other stuff, sullying up the process. So think about this process, because in this page I've actually captured what I'm trying to do. You have an equity multiple. I go back to a dividend discount model, not because I want to use the model, but because it tells me what I need to control for when I look at equity multiples. If I have a firm value multiple, I go back to a firm valuation model, do the algebra. There is no way I can ever prepare you for every multiple you're ever going to run into. But if you have this process, you can, in a sense, deconstruct any multiple that's thrown at you. So if I say I'm valuing companies based on number of subscribers, value per subscriber, take it through the process. It works amazingly well. By the end of the process, you can say, a subscriber on an intrinsic value basis is driven by these 3 variables. Tell me why a subscriber is worth $85 per subscriber. It's a process by which we can get past the pricing and start asking sensible questions about whether we're overpaying for something or not. Okay, so let's stop there. When we start off next session, we will do the last piece of pricing.
Yeah, found 500 value.
You got to find a multiple, you got to decide how to control for differences, and tell me which part is cheaper to how much it is.
So we can use this.
Whatever technique you talked about in class, that's I get it.
Okay, thank you.
Only remember there are 183 companies.
Yeah. So
Right, so if you put them on a graph, it's not. So you have to figure out creative ways you can take the data and try to control for differences. Across 183 companies, different countries, different sectors, different growth. So there are lots of things to control.
Thank you. So I talked to you, right? I'll be in India, so you'll be able to talk to me in India with that.
Yeah.
So that's good. And I have a picture of yours with the Indian ambassador when you were at the guide.
Okay, yeah.
So I'm going to use that.
Okay, great, thank you.
You mentioned country risk.
Yeah.
So would that be based on a similar process as country risk premium, or is that?
Yeah, it's based on actually the country risk scores are based on wider processes. It looks at political risk, economic risk, deposit risk.
How do you estimate?
Well, that's all they do is they collect data on countries, they attach a weight to how much each one is. So it's a subjective process, but they, like Political Risk Services, PRS, actually sells this. This is their product.
Right.
They have hundreds of analysts working on this, creating country risk scores.
And do you think that those, because I guess that factors into the country risk premium and valuation techniques, but do you think that there's a separate element, like political risk and things of that
They
sort?
actually have 4 different scores. There's a political risk score, economic. This is the composite. They have a composite score, but they also have separate scores. So if you want to focus just on the economic risk score, there's one. There's a legal risk score, there's a political risk score, and there's a composite risk score. There's all of them together.
Was there ever a point where you were more confident in pricing than valuation?
It doesn't come easily to me, so pricing is never my. I always price things after value, because I don't think it's either or. Nothing stops me from pricing. So if I can find something that's both undervalued and underpriced, I can do things well.
Thanks.
I think my DCF, but I never got it.
I would probably put the wrong heading. So I said, okay,
got 90% is my retention ratio, and your spreadsheet had 60%. Is that just coming from capex minus working capital change? Like 30 over 50 is 60? Is that where it comes from? Or?
Yeah, you can figure it out. Look at what I subtracted out for 50. Yeah, free cash flow of the firm is 20.
Okay.
What is my reinvestment? So when you add and subtract, one quick way to check whether you're subtracting something you should be adding or adding something you should not be subtracting is look at your free cash flow.
Makes sense.
Yeah?
Thanks.
When you value an S corp,
Yeah.
then when you do an FCFS, can you assume tax rates in the future are going to be zero?
The problem with S-corp is the past somebody's paying tax.
Right.
Right? So you can't assume zero. It goes to so because you're forced to pay the entire income as tax, it's actually the tax rate of the people who are invested in your S-corp. You have the tax rate. Because there's no value, it's not, you can't do a zero tax rate because that's in limbo, right? That income goes to somebody that's taxed. So it's got to be based on the personal tax rates you face or the income flowing through to do it. Anytime you have a pass-through entity, you can't assume zero tax rate. You've got to think through the tax rate. And unless you have a very special case of an S-corp owned by tax-exempt individuals. Otherwise you can overvalue companies, right? The other is you can say it's a pre-tax cash flow, pre-personal tax cash flow, but then your discount rate has to be pre-personal tax discount. So the discount rates will get much higher. All the equity risk premiums we have, cost of equity computed are post-tax.
Yeah.
So if you're using pre-tax numbers, those numbers all have to be scaled up. So one way or the other, you're going to have a lower value, right? Either by lowering the cash flows to reflect personal tax rates, or raising the discount rates to reflect the fact that you're looking at this intermediate discount rate. Because much of the discount rates you get come from public companies that are taxed. So you'll have to scale up. Yeah, so instead of having a 6% equity risk, you'll have an 8 point something percent equity risk. If you want to use a zero tax. Yes.
About like country risk. You're saying there's like maybe some additional resources to get like more granular.
Yeah, the political risk service allows you to get a score for every country. I reproduce it on my website. If you go to my website and you download the country risk premium website, there's a worksheet with political risk scores at the start of 2000. Actually, it's July of 2015. The reason I do that is if you go to the political risk services website, you can get it yourself and cost you $100.
And do they break down like how they arrive at that? Okay.
There are actually 4 different scores. There were political